Welcome to our in-depth exploration of today's top crypto trends. We'll examine major shifts in regulation, institutional adoption, security challenges, innovative technology layers, and macroeconomic drivers, unpacking what they mean for markets and participants in the rapidly evolving digital asset ecosystem. The U.S. Senate has passed the Genius Act, ushering in a new era for stablecoin regulation. This legislation mandates one-to-one backing in cash or equivalents, robust audits, transparency obligations, and federal oversight, elevating stablecoins to recognized digital payment infrastructure. Under the Genius Act, issuers with over $10 billion in circulation must undergo independent audits and hold reserves in high-grade cash instruments. This level of regulation is unprecedented for crypto assets and aims to prevent systemic risks while enhancing consumer trust. Debates over regulatory jurisdiction are heating up, with concerns about overlapping authority between the SEC, Fed, OCC, and CFPB. Some experts advocate for a unified regulator under the Fed to avoid conflicting rules and foster coherent governance for stablecoins. In the House, lawmakers are pushing amendments focused on consumer protections and regulatory clarity. Talks around whistleblower provisions, conflict of interest guardrails, and cross-border compliance measures are ongoing ahead of anticipated floor votes this summer. Market participants are already taking action. Circle's USDC arm saw its value proposition sharpen while Tether faces pressure to align with new reserve requirements or risk losing market share in non-US jurisdictions. Meanwhile, the Senate's companion market structure bill aims to define digital asset trading, custody, and classification rules. It seeks to clarify whether tokens are securities or commodities and implement modern standards for exchanges and custodial providers. Backed by champions like Senators Lummis and Scott, this combined regulatory momentum suggests a synchronized U.S. regulatory framework could emerge by year-end, potentially reshaping the domestic crypto landscape across major asset categories. Down in Europe, MiCA is live and fully enforceable. Licensed platforms like Kraken and Coinbase can now operate across all EU member states under one harmonized legal structure, making Europe the first region with broad-scale crypto regulation. Successfully licensed under MiCA, Kraken continues to expand its European reach, while Coinbase secured its EU passport via Luxembourg. These moves lay the foundation for pan-European onboarding and regulatory compliance at scale. In Asia, regulators are tightening the screws. Singapore's MAS requires exchanges serving international users to obtain local licenses before the end of June. That deadline has triggered a migration wave toward crypto-friendly hubs like Dubai and Hong Kong. Japan and South Korea are deepening their compliance systems, particularly around NFT marketplaces and decentralized finance protocols. This includes mandatory KYC, AML controls, and oversight on token issuances and smart contract audits. The UK is also stepping up. The FCA and HM Treasury are drafting rules targeting DeFi platforms, staking mechanisms, and broker-dealers, aiming to implement a clear crypto regulatory framework by 2026, signaling mainstream integration. At the US state level, regulator responses to crypto kiosks are expanding. Illinois, Arizona, Rhode Island, and Vermont have introduced licensing, transaction caps, fraud warnings, and compliance standards to combat the surge in ATM-based scams targeting vulnerable populations. ATM-based crypto fraud hit tens of millions in recent years, particularly affecting elderly users. Legislators are demanding mandatory safeguards, receipts, verified transaction limits, real-time alerts, and more robust dispute resolution mechanisms. Security is under high scrutiny after the February Bybit exploit, in which approximately $1.5 billion in assets was stolen. This state-associated attack exposed weaknesses in multi-signature wallet structures and threat model oversight. Exchanges responded swiftly, deploying emergency liquidity backstops, tightening withdrawal limits, and accelerating insurance coverage upgrades. Internal security audits and third-party penetration testing programs have been bolstered in the wake of the hack. Vulnerability disclosure schemes are being modernized. Bug bounty programs are being expanded to cover complex DeFi integrations and cross-chain bridges, recognizing that sophisticated attackers will probe under rewarded weak points. Chain analysis firms like Chainalysis and TRM Labs collaborated closely with Bybit and global law enforcement to trace stolen funds across decentralized bridges. Their efforts reportedly led to successful recoveries and seizure of illicit pools. Market liquidity rebounded in record time. Within a month, BTC liquidity returned to pre-hack levels, while altcoins lagged behind, indicating institutional capacity to absorb major shocks and restore order amid uncertainty. Institutional inflows remain strong. From April to now, spot Bitcoin ETFs have seen AUM climb from $90 billion to over $130 billion, demonstrating sustained demand from macro hedge funds, family offices, and corporate treasuries. Public Bitcoin miners like Cypher, CleanSpark, Riot, and Marathon have benefited. Stock analysts are assigning buy ratings, attributing them to rising BTC, increasing mining scale, and clarity around electricity sourcing and environmental compliance. Coinbase is positioned to thrive. After securing its European passport and leveraging US stablecoin regulation, its stock has surged, and it is now built as a compliant bridge between legacy finance and decentralized ecosystems. In parallel, US banking reform is reshaping engagement. The Fed's removal of reputational risk from risk assessment policies now allows more banks to serve crypto firms without fear of regulatory backlash, a shift from prior restrictive programs. Tax compliance is tightening. Brokers must issue IRS Form 1099-DA starting January. Internationally, the US is collaborating in the OECD Crypto Asset Reporting Framework to share cross-border transaction data and improve reporting compliance. At the federal funding level, Fannie Mae and Freddie Mac now consider crypto holdings as mortgage-eligible assets. That policy breakthrough acknowledges digital wealth in underwriting processes, opening new pathways for wealth utilization. This recognition triggers potential mortgage access expansion for crypto holders, though lenders must develop evaluation frameworks that address price volatility and borrower risk profiles. Regulatory alignment will be key. On the Treasury front, stablecoin issuers collectively hold an estimated $200 billion in short-term treasuries, boosting demand, influencing yields, and increasingly participating in the floating rate curve as USDC and others grow. Central banks remain cautious. Institutions like the Bank for International Settlements argue private stablecoins don't meet foundational criteria for money and promote central bank digital currencies, especially where fragmented regulation persists. Innovation continues apace. Projects like Taurus and Aztec are introducing zero-knowledge powered privacy tokens, enabling confidential transactions with regulatory visibility, a new frontier in compliance encrypted design. On-chain trends reveal June token unlocks for DeFi projects, some large but not peaking like May. However, institutional holders appear to be absorbing these releases with limited price disruption, signaling deeper liquidity demand. Analysts see Ethereum positioned for an alt season. Strength in ETH, BTC pairs and rising capital inflows into Layer 2s and mid-cap protocols suggest potential 30 times tilde 100 times upside windows if technical signals hold. Layer 2 expansion is unfolding, with networks like Base, Optimism, and Arbitrum attracting users via reduced gas costs and improved throughput. Composable ecosystems and cross-chain bridges now push DeFi mainstream. Institutional adoption is spreading into tokenized real-world assets. Tokenized treasuries, tokenized credit, and digital bond pilots on blockchain infrastructure are delivering regulatory-grade use cases beyond pure crypto speculation. Stablecoin mechanics are evolving too. Tiered peel-off models, reserve waterfall triggers and liquidity-backed safety layers are being tested by projects to prevent runs and enhance stability during market stress. Quantum computing and AI-driven cyber threats are rising. Protocol teams are evaluating quantum-resistant cryptography, zero-knowledge systems and decentralized identity frameworks to future-proof blockchain security. Regulators are embracing compliance technology trends. Travel rule implementation with verifiable credentials, enhanced on-chain analytics, and real-time monitoring are becoming standard across exchanges and DeFi platforms. Cross-border regulatory alignment is being prioritized. Interoperable rule sets among the US, EU, UK, and Asia would foster global compliance infrastructure, a roadmap toward harmonized crypto markets at scale. Macro trends remain influential. Dollar weakness, inflation expectations, risk-asset correlation, and bond yield pressures are elevating crypto as both risk-on exposure and emerging store of value asset for diversified portfolios. Geopolitical tensions impact crypto behavior too. Recent Middle East flare-ups triggered temporary dips, but Bitcoin swiftly recovered, signaling speculative resilience and evolving asset thesis beyond haven narratives. On policy, sovereign nations are actively building digital asset strategies. El Salvador and Bhutan continue stockpiling BTC, while China quietly retains crypto reserves, signaling a rising trend of nation-state engagement in digital asset exposure. ESG and energy compliance initiatives are growing. Mining firms now source renewable energy, obtain green certifications and emphasize carbon accounting, while regulators assess energy mandates in key jurisdictions. Layer 0 protocols are progressing as well. Projects like Cosmos and Polkadot expand interchain governance, interoperability, and shared security mechanisms, paving paths toward a multi-chain decentralized future. Governance models are evolving beyond token-based voting. On-chain governance experiments, reputation models, and quadronomic DAO structures are gaining traction as more sustainable and participatory alternatives. In conclusion, crypto sits at a pivotal juncture defined by regulatory harmonization, institutional acceptance, heightened security, technological breakthroughs, and macro interplay. These forces combine to position digital assets as cornerstones in the future of finance. Thanks for watching, stay engaged and see you next time.